Hello everyone, this is Kishore. Welcome back to my channel. Today I'd like to share my analysis on housing market. So to cover the housing market, we need to cover these four topics like mortgage interest rate, home inventory and sales, home price, and employment situation. Without covering any one of these topics, I feel like housing market analysis is incomplete. Today in this video, I'd like to cover mortgage interest rate, but on my next video, I'll do home inventory sales, home price, and employment situation. This is not a financial advice, just knowledge purpose only. Let's jump into the show. Fed has dual mandate, means they need to make sure price stability and max employment in the economy. If any one of them is not balanced, then they try to control with the help of Fed fund rate and balance sheet reduction or increase. So like a quantitative tightening or quantitative easing. Any change in these two will impact the 10-year note yield and that impacts the mortgage interest rate. I'll go deep, very deep in this slide in next few minutes. And September 18, during FOMC meeting, Jeremy Powell cut the 50 basis point of Fed fund rate, and everyone thought mortgage interest rate goes down, home sales goes up, home prices goes up. But if you see 30-year and 15-year conventional fixed mortgage rate after FOMC September FOMC meeting, they went up, and both of them are went up. So why? And if you see at FOMC meetings, on almost all participants agreed that the upside risk to inflation had diminished. Means Fed has dual mandate, right? The first one is price stability, means inflation. So they don't have any concern on the inflation now. And most remarkable that the downside risk to employment had increased, means they have concern on the employment side, not on the inflation side. And also, ongoing reduction in the Federal Reserve's balance sheet could continue for some time, even as the committee reduced its target rate from the federal fund rate. Means they cut the 50 basis point cuts of the federal fund rate, but they want to continue the balance sheet reduction, means quantity. They want to continue the quantitative tightening. This impacted the mortgage interest rate. And Fed fund rate, previously it is 5.5, now after 50 basis point cut it came down to 5. And what is effective federal fund rate? The effective federal fund rate is calculated as a volume weighted median of overnight federal funds transaction reported in the FR 2420 reported of selected money market rates. Means changes in the federal fund rate impacts the money market rates, not the capital market. What is money market? Any bond that matures within less than 1 year is called money market, like 1 month, 2 month, 3 months, 6 months, or 1 year. Any bond that matures above 1 year, like 2 year, 3 year, 5 year, 7, 10, 20, and that are called capital markets. So the changes in the federal fund rate impacts the money market. And any bond that matures within 1 year is called bills, and they have auctions weekly. And any bond that matures within 2 year to 10 years that called notes, and they have auctions monthly. And any bond that matures with the 20 years and 30 years, that is called bond, and they have auctions quarterly. And if you see here, this chart shows three things. One, SHV, like short interest treasury bond, which means treasuries that matures within less than 1 year, which is like a money market rates. And TLH, which is like a 10 to 20 year, which is a capital market bond, like a long-term bond, and TLT is 20-year bond. Both TLT and TLH are going down even after 50 basis point cuts. Only short-term SHV is going up. Bond prices and yields are inversely related. Means if bond prices goes up, yields goes down. If bond prices goes down, yields goes up. You can clearly see here the 20-year and 10-year, the prices of the bonds are going down, which means the yields are goes up. That's the reason you can clearly see mortgage interest rates are going up. And the other part is balance sheet reduction. Fed want to continue that balance reduction, so they want to do quantitative tightening now also. I mean, they don't want to do the quantitative easing, or they want to cut that one. They want to continue that quantitative tightening. That impacted the 10-year note yield. And in this slide, the top part is 10-year yield and the bottom part is mortgage 30-year interest rate. So if you see the chart patterns are looks very, very identical. Means if 10-year yield price is going up, then mortgage interest rate also going up. If 10-year yield is coming down, 30-year mortgage interest rate also coming down. This chart helps us how the history is or how the current price is. How do we know the future price? How do we know how the future price for the 10-year bonds? For that, we need to look into the commitment of traders report. So the commitment of traders report helps us how the future asset price. And if you see a COT index, it is going down. Means it helps me to understand the trend of the asset, even not the price. Just I want to know the trend. So the trend is down. So it means the 10-year bond prices goes down in coming weeks or months, which means the yields goes up. And mortgage interest rate is depending upon the 10-year yield, not the bond price. And how do we know the demand for the bond? When Treasury securities put the auction of a bond, we need to see the bid to cover ratio. What is bid to cover ratio? Means, for example, for a 10-year bond, if they announce a 10 million 10-year bond, and if they got the bids for 25 million for that bond, then means 25 by 10, which is 2.5. The bid to cover ratio is 2.5. And if it is above that red line, means moving average of the last six auction prices, then it is okay. If it is below that, then that will be a little bit concern on it. Why? Because if the people who are buying, so people like foreign investors or foreign banks or investment within US investment banks or asset management, they buy the bonds. If they have faith in the economy, or they have no uncertainty in the economy, the bond will have demand. People want to buy bonds. Otherwise, if they have concern in the economy, then they are not interested to buy the bonds. And these are the major foreign holders of the United States Treasury security as of April 2024. If you see majorly Japan, China, and Kingdom, they are the major Treasury securities buyers from the foreign. But recently, both China and Japan, they are selling the US Treasury securities. They are not that much interested to buy the US Treasury securities. And on October 10th, 10-year Treasury yield stops 4.10% as Fed Bostic says he's okay with pausing rate cuts because the 10-year bond price is going down and he has some concern on it. And he said, I'm okay with to pause the further rate cut of the federal fund rate. In this slide, the top part is federal fund rate and the below part is US 2-year yield. And if you see, 2-year yield will give the leading indicator for how the federal fund rate would be. If you see here in this on 25th June of 2007, it started going down. Then after that only here the price of the federal fund rate went down. Here also the same on 2018 October it started going down, then only later after few months it went down. Now again on 27th May 2024 the 2-year yield went down. After that only we have the 50 basis point. So this helps us the it helps us the leading indicator for the federal fund rate. But right now it's going a little bit up. Whenever it is going a little bit up, I see there is a pause in the federal fund rate. But let's see what happens in the next FOMC meeting. But right now the chart says there is a high probability of federal fund rate pass. And this is annual inflation rate. We saw that Fed has dual mandate, right? One is price stability, which is inflation, and in the FOMC meeting they said like they don't have any concern on the inflation. And if we see here annual inflation rate on 2023 it is 3.5 and now it is 2.4, and the forecast is 2.3, but it's okay, we got into the 2.4. And the average inflation rate for each year using CPI data. So let's see how the CPI data is. And this is CPI data, and it is slowing down last six consecutive months to 2.4, which is good. Even the forecast is 2.8, it came to 2.4, but it is falling last 6 months, which is very very good sign. And what helped it to come down? One is shelter came from 4.9 to 5.2, which is very good. And the other one is energy costs. These two are helped the CPI data to go down. And if you see the core CPI data, like core CPI is like removing exclude food and energy, because food and energy are very volatile. The price of food and energy are volatile. So if you remove them, the core PCI data is little bit up, not down, because the price of food went up. Even though energy is down, the price of food went up. That put the core CPI data more than the previous level. And what are the components in the CPI? So based on Statistica as of September 2023, not 2024, the housing is major, like it's almost like 45%. And next one is transportation, food and medical care. And also the medical care also went up. Housing went down. That's a very the shelter, which is good one, that is a major part in the CPI data, and that went down. That is really good. And if you see our September CPI data, energy commodities they went down from minus 0.6 from August to September, minus 4, which is good. Only thing is sheltered, like that is also good, like 0.5 to 0.2. Only increase is transportation services and medical services. Transportation services increased 0.9 to 1.4, and medical care services went up from minus 0.1 to 0.7. So these two are went up. That put the core CPI or the CPI little bit more than the forecast. Otherwise, the CPI and core CPI might down a lot. And this is like a 12-month percentage change. Medical care services, that's like a V-shaped recovery. It came down to the minus almost minus 2.1, and from in 2023 from there it is going up. So this pushed the core CPI and CPI a little bit up. And Gasoline price helped the CPI come down, like it is going down. That's a good sign. And also the shelter also going down. Shelter peaked in 2023, and from there it is 2022, end of 2022, and from there it is going down. This is very important for the mortgage interest rate. So the shelter, we need to look into what are the components and the major components in the shelter. One is the shelter component of the consumer price index is the cost of housing services for tenants and homeowners, rent of primary residence and owner's equivalent rent. These two are the major components in the shelter. And if you see here, US consumer price index core services, it is going down from it peaked in 2023 of February, March. From there, it is going down. So that helped the shelter prices to go down continuously, and that helped the CPI data, because we saw that in the CPI components, housing is one of the major components, almost like 45% as of September 2023. And that brings the next topics like home inventory and sales and the home price. I'll continue this on then my next video of home inventory, sales, home price, and also the employment situation. And finally, if you see at the Fed, so dual mandate like price stability and max employment, and they don't have any concern on the inflation. And we saw that shelter is going down, only concern on the medical care services and transportation. And max employment, they have concern the employment side. That is one of the main concern why the 10-year bond yield went up. And Fed fund rate, they cut down from the 5.5 to 5, and they continue the balance sheet reduction, which is like quantitative tightening. That impacted the 10-year note yield, and that impacted the mortgage interest rates. So that's all for today. Hope you like this video. If you like this video, please hit the like button. Please watch more videos in my channel. If you like that, please subscribe. Please hit the bell icon so that you'll get notification when I upload a new video. Please share this content to your friend looking similar kind of content. Thanks so much. Bye bye.